Welcome back, everyone, to Lamb's Cryptoverse. This presentation is not financial advice. As a matter of fact, today I'm going to not entertain you, perhaps, but educate you. So let's get started. So the title of today's presentation is The Many Contradictions of Crypto Projects. I spent quite a bit of my time looking at individual projects, and what I'm seeing is one data source says one thing and the other data source says another thing. And here in this presentation, I'm going to give you some examples of that. This way you can be more careful when you're doing your own research and you're seeing that one source says something and then another source says something else. Or maybe you just hear from one source and that's all you rely from. You don't want to do that. You want to make sure you get as many sources as possible. As I've told you before, I have at least 60 to 70 data sources, websites and whatnot. So let's get started. So my background is of credit and equity analysis. I have a CFA designation and FRM, which was very important, especially managing money. It's very important to have FRM because that's financial risk management, basically. And what else could I tell you? I actually started out with technical analysis. So I have used a lot of technical analysis and charts. But the problem with the crypto industry, with the so-called experts out there, is that they spend 90% of their time showing you a chart. And they go over it and over it until they just kill it. They just pound and pound you with the same chart with support lines, resistance lines, candles, Fibonacci, demarking indicators, you name it. So let's get started. Let me show you some examples of what I'm talking about. Oh, before I do that, let's give you a historical background of equity and credit analysis. As you know, crypto has very few years of study. And this is why I like it, because I feel like it's a new and open area for me. And it's a way of me developing my own skill set rather than relying on someone else's. So let's see what we've got here. In terms of technical analysis, this has been going on for many years. And some people say hundreds of years, going back to the Netherlands. But the modern text, which I actually read, the Bible of the modern technical analysis, is the one from Robert Edwards and John Magee. They wrote this thick book on technical analysis. Many people and myself were also influenced by William O'Neill, who's the founder of Investors Business Daily. And for fundamental value investors, I think we all know who the big guy is back there. Big guys, I should say, Graham and Dodd, right? And for credit analysis, many people don't know, but it was actually Alexander Wall and a chemical company out of all places, that invented it, and that was DuPont. And that's the DuPont company that invented all sorts of ratios, and I actually had to study this when I was trying to get my CFA designation. There was something called DuPont analysis, where you had to figure out how return on equity was formed by breaking it up into different parts, like assets over equity and EBIT over sales. I'm trying to remember the formulas, but it was a pretty interesting formula. So here are the key advantages to historical credit and equity analysis. Of course, there was lots of history. The definitions are clear. There's empirical evidence. That's very important. And I give you a chart here. This table shows you that credit ratings actually are related to defaults. And you could see on your own, you could see that the lower the credit rating is, the higher probability of the default. And of course, data is reliable. And there's historical data. You can get it easily now for free. You don't need to pay Bloomberg, whatever it is, $4,000 a month. You can just get it from Seeking Alpha. So blockchain, I don't know where to get started. Mamma mia. There is so much going on here. There's limited data history. There's The projects are more like venture capital entities, they're more like venture capital portfolio companies. And then you're dealing with venture capital companies, and that's another issue because they're trying to control the whole industry. And the definitions are not clear. The KPIs, meaning key performance indicators, are sometimes contradictory, and we're going to talk to you about that later. There's no framework on how to analyze these crypto projects. There's no empirical evidence. There's no back testing. You can't download the stuff. Investment banks like Morgan Stanley, Goldman Sachs don't even cover this area. If they do cover it, they cover it from a top-down point of view, like what is Bitcoin, what does it mean? They're not talking about all researching individual projects. So let's get started here. Let me go to the next slide. So here are some examples of what I'm talking about the contradiction of crypto analysis. Here's the first one. Is the project decentralized? Right? You want a project that's decentralized. So you see, you see that, wow, it's got 1,000 validators. It must be decentralized. But then you see that most of the validators are on Amazon Web Services or Microsoft Azure. So is that really decentralized? And then you find out, okay, maybe it's decentralized. It's not on Amazon Web Services. But and I should say not but and it's got decentralized on-chain governance. So it's good that, number one, its governance is on-chain. And number two, they're calling it decentralized. But then you look deeper and you find out that they call it a DAO. The DAO, Decentralized Autonomous Organization, is controlled by a few entities. So there you have it, there's control. So maybe it's not decentralized. Then you look again, it has many validators, so it's decentralized. But then you look at that and you notice that the foundation controls the server software or the administration keys, and we see that with Ripple and some other projects. So that means it's not decentralized. So that's what I'm talking about when I'm saying it's very contradictory. You think it's one thing when it's not. Let's go to another example. Is the project decentralized? This is just showing you a table from Invest Answers that shows you the projects that have the most validators. And we talked about implicitly about Ripple and I think Solana. Let's talk about Ethereum. Ethereum has many validators and it looks like it's decentralized, but is it? Because now they moved to proof of stake from proof of work. So you have to think twice about that. Is the project scalable? Well, it's super fast. But wait a minute. It has slow finality, meaning it's settled slowly. So is it really fast? And here's, I'm going to my third point here. Well, it's fast now. It's super scalable now. It's super fast. But what happens when it has 1 million users? Is it still going to be fast? So that's another way of looking at scalability. It's not just speed. It's speed as size grows. So when a project's really large, is it still going to be fast? And I think I mentioned something else. Yes, it's super fast, like Solana, but is it getting attacked every other day? So how scalable is a project if it's still in beta form like Solana and it's getting hacked and attacked all the time? Maybe not. You're paying a price for that speed. Okay, let's get away from speed and move towards TVL. This is total value locked. It's important that total value locked is large and that it's growing. However, maybe all that total value locked is coming from one app, one faddish app. So if it's a faddish app, it's not going to last too long. So maybe no, it's not a good thing. It's growing, but it's only from one app. Or maybe this is the third point here. Maybe yes, total value locked is growing. However, there's $100 million incentive development program, meaning that cash is being thrown for apps to be developed. So maybe that's not going to last too long. Let's go to another point. Let's see here. Yes, I said that the apps are growing fast, that the total value locked is growing fast, but maybe that's not really growing quickly because it wasn't EVM compatible. And that means Ethereum virtual machine, like Avalanche. So maybe the TVL grew rapidly because the apps would literally cut and paste. So if they cut and paste, you're seeing a short-term migration from Ethereum to maybe Ethereum. From Ethereum to Avalanche. And so that's not a long-lasting growth in total value locked. So you have to look out for that. Here I showed you in this diagram here that the Avalanche Rush was actually a $180 million DApp incentive program, DeFi incentive program. So that led to a short-term increase in TVL because of that money going into it. And that's a short-term thing. Tokenomics. This is something I like to spend a lot of time on because I think tokenomics is one of the most important factors when you're looking at a crypto project. So what did I write here? Yes, there's a maximum limit. You always want to look for a maximum limit of supply. But here's the problem. If the maximum limit of supply is like, say, 100 million, but the circulating supply is only 30 million, so that's what I wrote here, 30% of max. That max supply means nothing because you still got we're at 30% max, right, with circulating supply. So you still have 70 million coins that can be dumped on the market. So let's look at it from another point of view. In my third bullet, I wrote, yes, tokenomics is good because inflation is minimum. But I wrote again, but circulating supply is low. So remember, if your inflation is minimum, that's a really good thing, but your circulating supply is going to go up, that's a bad thing. So it's very contradictory. So let's go to the next point. Fourth point, I put that there's a maximum supply. But the project I wrote down in my, whatever that is, eighth point, no, there's a maximum supply, but the project has assisted chain. That means like a dual currency or there's a related chain. And a good example of this is Engine. Engine has not only max supply, but it has a very good circulating supply. So it's almost like Bitcoin. It has a very good tokenomics. But Engine introduced another project called Infinity, which is on the Polkadot chain. And the Infinity token or project has a lot of supply. So that's something else to watch out for. You need to look for dual currencies in related chains. I call it sister chain here. Okay, next bullet. There's a maximum supply. So that looks good. But what if there's an accelerated vesting schedule? And we saw that with Algorand, where a vesting schedule allowed dumping of the whale's tokens, of the founder's tokens, if the price of Algorand reached a certain level. And then I wrote, in the second and last point, the tokenomics are good because there's fee burning to reduce inflation. But, what if there's not enough fees to burn? So that you have to be careful. Just because there's fee burning doesn't mean there's going to be enough fees to burn and reduce inflation. So it's very contradictory and confusing. Next slide. Is a project considered security by SEC? So basically, if the project is considered security, and many projects are, the SEC can fine them or prohibit them from being traded on exchanges like Coinbase and Voyager and FTX or Binance. So you're thinking if it has many validators, right? Many validators, like over 100 validators, it's a good thing. So it's no. I put no here. The project's not going to be considered a security by the SEC. However, what if the Nakamoto coefficient is low? That's not a good thing. So for example, if you have 100 validators, 100 or more than 100 validators, but your Nakamoto coefficient is 1, that means you only need to hack and control one validator in order to control the project, the whole system. So that's not a good thing. Actually, I did a video down there, you can look it up, that actually talks about the Nakamoto coefficient, what it is, and how to interpret it. So I highly recommend you look at that video. Next, I put no. This is the third point here. No, the project is not a security because it has many validators. But then I put yes, maybe it is a security because it's moving from proof of work to proof of stake. Now, if you remember, Jay Clayton, the previous SEC chairman, said that Ethereum and Bitcoin were not securities. But this this SEC chairman is alluding that Ethereum could be a security because they recently moved from proof of work to proof of stake as of what happened on September 15th, the merge. Let's go to the next point. I said here in the next point, this is number 5, I said no, the project is not a security because it's decentralized and it has a DAO, so it has an on-chain governance. But then I said yes, maybe it is a security because a DAO could be controlled by a few key persons. So you have to be careful with DAOs. DAOs and even staking, everything in nature tends to centralize. So you have to be careful with that. Next point. I said no, and this is point number 8. I said it's decentralized, but however, maybe it is centralized and controlled because a for-profit corporation behind it or a foundation controls it. So always be careful. If you think or a project says it's decentralized, look into it because it could be a foundation or for-profit corporation, like in the case of Ripple, that actually controls it. And second to last, I said it's really, really decentralized because it meets a Howey test. However, and this is my last point, the SEC governor, what's his name? Gary Gensler said in a speech I heard, he said, if it quacks like a duck and walks like a duck, it's a duck. And what he means by that is he doesn't care about the Howey test. He's going after almost all crypto projects. So again, if you think your favorite project is decentralized and it's not a security, think twice. Next slide. So key takeaways. How should you view projects? You must use a holistic approach and look at everything together. And what does that mean? Try to get a good feel for the project. The team members, how's it feel? How's it run? How's the roadmap? Are they executing? Use many sources of information. Even if those sources of information are for the same item, you want to cross-check everything. Integrity, and my next point, number 3, integrity is everything. If the project looks great, but they don't have integrity, it's over, it's out. And always look at forward-looking data. Neo Protocol is a great example. They did not have enough validators, but they're working, they have a program, so they're working on increasing their decentralization. They're working on having more validators. They're very cognizant of that. So that's what you want. You want a team that has a good roadmap that's executing. And you should always look at risk, and they should be very seriously looked at and considered. And I did another video on this, on modern portfolio theory. In that video, in part 2, I talked about risk, that how you shouldn't be looking at forward returns, you should be focusing on where the risk is. That should be your number one criteria. And lastly, I'm a technical guy. I like using technical analysis, but for the crypto market, you should rely on fundamentals more than technicals. Well, thank you all for listening to Lem's Cryptoverse. Please like us and come again. Bye-bye.